joined by Piers Hillier. He's Chief Investment Officer at Liverpool Victoria Asset Management. Piers, thank you so much for coming in. Every day you must be thinking, wow, I'm not sure exactly what's awaiting for the markets because there's so much volatility and some of it is really unreasonable. It's a lack of liquidity, it's concerns about the markets and about, of course, this debt ceiling. When are we going to see the situation stabilize a touch?
Well, I think the policy setters actually realise there's now a problem. I think most people went on holiday. Classically, August is a quiet month for markets, and I, for one, was certainly surprised when the volatility kicked off quite as quickly as it did in August. Normally, you wait till September, you've got some indication of what Q3 numbers look like. The market makes up its mind whether GDP growth is going to be a positive surprise or a negative surprise. So August is quite unusual. A lot of policyholders, a lot of main investors away on their sort of summer breaks, and so that provides a great opportunity. I think structurally, we've got a problem this year which we haven't had historically. There's been a lot of regulatory change, which has meant that classically market makers and participants who normally provide some form of classic curbs in the marketplace aren't there. So Dodd-Frank in the US has removed a lot of market makers classically from investment banks who would normally be there as prop traders. They've gone elsewhere. And we've also seen the impact of Solvency II and Basel III, basically meaning classic long-term investors, whether it's life insurance companies or pension funds, who have effectively been net sellers of equities and risk assets. And so the high-frequency traders, a lot of computerized trading is increasing the volatility, and you haven't got the classic, what I call curb-type investors there who provide support on the other side.
But Piers, it seems also August has always been a quiet month, but almost 3 years ago, day per day, was the first time that we heard about the credit crunch because it was one of the BNP Paribas funds that started having troubles. Are we going to see another credit crunch? Because if we have a lot of liquidity taken out of the markets and certainly money markets being, to the throat, what happens next? Are we going to see another recession or another financial crisis?
Well, that's a very good question, and one we looked at very, very closely this week. And actually, if you look at interbank lending, you haven't seen major pressure there. I know BNY in the States came out and said we'll charge you on cash deposits, but actually, if you look at interbank lending markets, you haven't seen the spike in volatility you've seen associated with the 2007 and 2008 vintage. Let's remind ourselves, it was 2-year run-up to Lehman going bust when we really had volatility back at these sorts of levels, and that's why this is quite unusual. Interbank markets not suggesting that. Certainly when we talk to banks, and we look at Commerzbank's results yesterday, they were a positive surprise. They wrote off much more than people thought against Greek debt, and actually they beat the numbers. And remind ourselves, they had a rights issue only in May, and that accounts for more than half the market cap of the bank.
So you're not that attracted to cash, actually, because of course it's lower yields and you're still overweight in developed nation equities.
Yeah, I think on the cash thing, we have been very underweight cash for nominal returns. And I think what we're looking at the moment is actually reducing our exposure to much shorter dated bonds and putting that into cash. And essentially, if you look at UK and US markets now, cash yields are the same as short dated bond yields. Well, I'd probably rather own cash here. I know we've had the Fed statement, I know we've had the Bank of England statement yesterday, and the mod market rallied very, very sharply. I think that's an opportunity, certainly at the short end, to maybe take some profits into this volatility. And I think for us, certainly what we've been looking at is dividend cover and looking at the quality of equity. When we look at our equity portfolios, certainly in our US equity portfolio, all our companies have dividend cover of more than 3 times. So yes, even if there is a crisis, I think there's a massive assumption that the economy is directly connected to the stock market. I'm terribly sorry to disappoint people. It isn't true. The US economy is 25% correlation with the US stock market. The US stock market is a global market. The UK market in many ways is the same. Now, some of these issues we've had in short term is policy setters.
Yeah, but the problem is that when you have more than $1 trillion being wiped off the market, is that although there's a disconnect, it's the investors that are suffering and shareholders. So would you be buying in today's market session? Would you wait for a couple of days for the markets to fall further?
I think throwing the magic dart, which is what you always want me to do when I come on this programme, is just simply not the right thing to do today. I think you have to do it incrementally, and that's what we've been doing. I've even been doing it with my own personal money and my children's money as well, is putting money to work gently in the marketplace, finding stocks. We bought some Sainsbury's the other day, PE of 8, dividend yield of 5.5. A lot of investment trusts in London blew out discounts, so over 20%, and that was a great opportunity for just topping up holdings. So I think incrementally adding here is a sensible thing to do. Volatility likely to continue until we probably get to September and people then really get some clear indication from corporate numbers.
And pure stock picking. All right, Piers, thank you so much. Piers Hillier there.